What's up, everyone? It's Karthik at MoneyVest. So markets briefly hitting a new all-time high and then rotating back lower in anticipation of what's going to be one of the most uncertain and unresolved Federal Reserve meetings tomorrow. So tomorrow's the big day, and market to this point is still very much unsure what the Federal Reserve is going to do. And it's all coming down to this one big day from the Federal Reserve. FOMC meeting tomorrow. We're going to be live to cover the entire event. Is it going to be 25 or is it going to be 50? It all comes down to Jay Powell and the FOMC. I'll be live in 21 hours, so make sure that you are joining us there. And we also already have a poll going on right now on that live stream, so definitely do participate. We're going to try to get to over 2,000 votes by the time those numbers are released. And again, that's the Fed rate decision. Are you expecting no hike, no cut? In other words, unchanged, a 25 basis point cut, a 50 basis point cut, or a 75 basis point cut? So definitely do participate in the poll on that live stream. Got lots to unpack in this video, so make sure that you drop a like and subscribe to the channel and share this video with your friends and family, other traders and investors that can benefit from this video, and get ready for what tomorrow is going to be a very, very incredible day. I also mentioned this in our Discord. The options portfolio almost at $92,000 now, and year-to-date returns are just clocking over 30%. 15 weeks left in 2024. So my objective and my message was very clear: keep it simple, keep it consistent. Base hits each week will keep compounding and adding. Stick to your strategy, trust the process, be patient, be flexible, and remember that this is a skill that you are learning. It's not a stock, it's not the next big winner idea. It's a skill that you are mastering over time so that you can do this for a lifetime. So this right here was the options portfolio. I pretty much send out updates every single day in Discord and of course on our Patreon with members only private videos. And this right here are the returns, just over 30% for this options portfolio. I think last year I also did over 25%, and the goal right now really is to continue to outperform the S&P 500, which of course on the year is also up very nicely, up over 18.7%. So link's going to be down below. We'd love to have you on board. There is a 16% annual discount that's available as well. So S&P 500 flat. The NASDAQ was up over 20 basis points, and the Dow Jones here just down about 4 basis points. So it's really the calm before the storm. And this right here is from Goldman Sachs. They are expecting the Federal Reserve to deliver a 25 basis point rate cut at its September meeting on Wednesday. BlackRock expecting the Fed won't cut rates as deep as the market expects. JP Morgan, though, predicting a 50 basis point rate cut next week. In other words, this week, tomorrow. And Citigroup, 25. Bank of America, 25. Goldman Sachs, 25. So this has been historically one of the most uncertain meeting for the Federal Reserve in over 15 years. So right now the market's pricing in for 65% probability for 50, and then a 35% probability for a 25. So most uncertain FOMC meeting on record. On record, by the way. This is not even going back 15 years. So September 2024, the most uncertain FOMC meeting since the data starts in 2015. And market implied probability for a 25 basis point cut versus, again, a 50. And this is where we are with so much indecision. So let us know in the comment section down below. Do participate in the poll because I think it's going to be very, very interesting, very exciting. I'll go over what my expectations might be and how the markets may react to what is going to be the numbers tomorrow. And this right here, again, tomorrow's Fed decision will be historic. The market has never been so uncertain about the Federal Reserve interest rate decision in at least 15 years. And if the Fed cuts by 25 basis points, it would mark the largest surprise seen since 2008 by a wide margin because everyone's expecting 50 right now. At least most of the market is. And on the other hand, if the central bank cuts by 50, it would mark the largest surprise since 2009. So really, it's on both accounts. It's either a bigger surprise on what the markets are expecting or a bigger cut going back as far as 2009. And the Fed has strived to avoid market surprises using its speeches and forward guidances since the early 2000s. Now, no matter the outcome, a significant part of the market will be disappointed. And I think this is going to lead to some significant volatility as well going into this meeting. So this is really just your volatility alert or your VIX warning, considering that the markets are just incredibly uncertain about what the Federal Reserve is going to do tomorrow. Now, here are some of my expectations and what I am expecting from the markets. My probability is also very split because, to be honest, like, I really don't know. I don't know what the Federal Reserve is going to do. I'm leaning a little bit more towards 25. That's why I've put in a 51% probability there. And the reason for that is because Jerome Powell has mentioned this before, that they are not going to make the same mistake that Paul Volcker made. And I think I'm really kind of holding on to those speeches and to those words, because Jerome Powell is really taking a page from the Great Inflation and from Paul Volcker's book. And he mentioned that if they cut rates too soon or too fast, it really risks getting inflation back higher. Now, there's been a couple advisors, even the New York Federal Reserve, Bill Dudley, he's been very close with Jerome Powell and the advisor to Jerome Powell. They've been advocating for 50 basis points. Elizabeth Warren, a couple other senators advocating for 75 basis points. JP Morgan, Jamie Dimon advocating for 50 basis points. So again, the market is very much excited and focused on a 50 basis point cut. That's really what the market's probability is, 65%. But a part of me is kind of holding on to that speech from Jerome Powell, where he's mentioned this time and time again, that if we cut rates too much too fast, we risk accelerating inflation back higher. And that would be a much bigger problem for the Fed. So the last thing they really want is to get inflation going once again. Think of it this way. It's a lot easier to become more aggressive with rate cuts than it is to backpedal on rate cuts. Meaning that if they start with 25, they can always dial up to 50 or 75 in the future, but they can never dial down, right? Meaning that if they go to 50 and if inflation starts accelerating back higher, or if they, go 50 and then 25, maybe 25 in the future, and if inflation starts accelerating back up, well, then we've got a problem. Right? Then they're going to have to, once again, pivot back to quantitative tightening to make sure that inflation doesn't get out of control again. So it's kind of playing that game where you can always dial up, but you can never dial down, right? So a very simple analogy that's kind of coming off of my mind right now is that if you're brushing your teeth, you take a little bit of toothpaste, you start with a little bit, you can always add more, but if you take a lot, you can't put it back, right? You can't put that toothpaste back into its container. So again, may not be the best analogy, but that's the best one I could come up with because it's 2 a.m. or 1 a.m. So I think that's really what the Federal Reserve is going to opt into, right? It's going to be a little bit starting slow, and then they can always dial up to 50 or 75 over time. And of course, a no change is going to be very bearish for the market. A 25 could also be seen as somewhat bearish because that would come off as a big surprise to the market. And if we do end up getting a 50 basis points, then in my opinion, that could be somewhat bullish in line with market expectations. However, that would also trigger a fast cutting cycle in the economy. And fast cutting cycles, as we already know, is not the best. Now, we also do have the summary of economic projections coming out. So the SEP is also going to be due. And these are the expectations from the Federal Reserve as of June. So June was the last time we got the SEP, and they were expecting 2.1%. For GDP. As of the second estimate for the second quarter, we're sitting at 3%, so we're way above the Fed's target right now. Unemployment rate, they were kind of pegged at 4%, so that was consistent with their March projection. Right now, as it stands, we're sitting at 4.2, so slightly above their expectations from back in March and June. When it comes to PCE, they were expecting 2.6. We're at 2.5 right now, so a little bit below expectations from back in June. And core PCE, they were expecting 2.8 by the end of this year. Right now, we're already sitting at 2.6. And again, the federal funds rate, they had increased. They had an upwards revision on the federal funds rate of 5.1. And right now we're sitting at 5.3. So we're, again, a little bit higher on the Fed's expectations as well. So, if you really consider some of these things, GDP is growing at a very strong rate. Unemployment rate is accelerating. It's softening a little bit, but not to any crazy levels. And inflation is below what the Federal Reserve has forecasted or had forecasted from back in June. So this would warrant rate cuts to begin with, but to what extent, of course, depends on the FOMC members and how much are they going to be pressurized into cutting interest rates. Now, this right here is the dot plot, which is also going to be very, very important because of all the FOMC members, and majority of the members expect interest rates to be sub 4% over the longer term. And by 2026 also to be under 3.5%, and then by 2025 to be under 4.5%. So rates are coming down, no doubt about it. There's a lot of FOMC members, projecting or expecting rates to come down, but it's really just the timing and to what extent the rates are going to come down to. Now, if the Federal Reserve does trigger a 50 basis point rate cut, it's going to trigger a fast cycle. Charlie Bilio also mentioned this in his post on X, that those calling for a 50 basis point rate cut next week should take a look back at January 2001 and September 2007, when the Fed started cutting cycles with a 50 basis point move. And if the Fed feels the need to go big because of a weakening economy, that's not bullish, is what he mentioned, because of the 50 basis point cuts that we've seen in the past. The 1 year, 2 year, 3 year, 4 year returns for the S&P 500 have not been super great. Now, there's differences, right? So obviously we can't compare today's economy to back in 2001 or 2007. Different systemic risks, different overall economic conditions, and different chairmans and different president, everything is different really at the end of the day. But it's really the idea of what that represents. As I mentioned in my previous video, if a 50 basis points is coming off of a panic or something that the Federal Reserve is trying to avoid because they've got access to more data, they're looking at more data points and different reports, and if they're seeing something or they know something the market doesn't, that's why it could not be bullish potentially, and so that's why 50 basis points could actually send the wrong message. It could be counterproductive, even though the Federal Reserve wants to get ahead of the curve, and again make sure that the labor market continues to be tight. It doesn't soften, it doesn't get worse, but it could send the wrong message because the market may, again, the keyword here is may, read into that messaging as that, okay, the Federal Reserve knows something that we don't, and the economy is weakening. That's why they're creating a 50 basis points rate cut here. That could send a little bit of a panic situation. That may not be bullish. But again, the economy holds the key here. The key here really is in the hands of the economy, and how strong is it going to be. Now, this right here is going over to the money supply, and if you really just overlay the chart for inflation, you'll actually see a very, stark similarities between these two charts. And as money supply went up during times of COVID, and as the Federal Reserve was printing a lot of money, buying a lot of treasury bonds, inflation skyrocketed, peaked out around 9%, and since then it's been rolling over. It's been coming down. It's been settling in at mid 2s and low 3s, and it's been really, really low for the last 1 year. But now you'll notice that money supply is growing once again. So it's back in the positive territory on a year-over-year basis, 1.2%. And a lot of that is happening because the Federal Reserve has pivoted, and they're now injecting liquidity once again because there's going to be cheap capital floating around as interest rates start to come down. So that is that potential risk for inflation accelerating back up from back in the Great Inflation. And that's really, I think, what the Federal Reserve, or in most cases, Jerome Powell, is trying to avoid. They're trying to avoid the possibility of a re-acceleration in inflation. So that's the last thing they really want, is to whatever hard work they have done to bring inflation down, is for it to go to waste only because the labor market was softening just a little bit. So yeah, that's the overall sort of overview, and really want to break down the summary of economic projections as well, because a lot of the things what the Federal Reserve projects here is also going to hold a key here, and the reason for that is because I really want to go over two charts. Number one is the summary of economic projections, and number two is what the markets are pricing in. So to give you some perspective here, market is pricing in for 5 rate cuts in 2024. So if I were to simply type that out, we're just going to put that over here. 5 rate cuts in 2024. So that's what the markets are pricing in. How? Well, 2 right now. So 2 tomorrow. That's 25 and 25. So total 50. Then 1 more in November. And then 2 more in December. So another 50 basis point rate cut is what the market's pricing in for December. So we got 2, 1, and 2. That's 5 rate cuts in 2024. Now you come over to the summary of economic projections. And what has the Federal Reserve told us? 1 rate cut, because right now we're sitting at 5.3, right? So over here, we're sitting at 5.33 basically, and going from 5.3 to 5.1 is just 1 rate cut. So right now we've got a huge discrepancy, right? Markets pricing in for 5. The Federal Reserve has told us 1. Now, what's going to happen tomorrow is a lot of possibilities. And that's really what I want to discuss here because, in my opinion, this number, the 5.1, is going to get revised down, right? It's going to come down to sub 5. It's going to come down to potentially 4.6, may even come down lower. But really, our job is to better understand how many rate cuts is Jerome Powell and the Federal Reserve now indicating to the market. So 5.1 is 1 rate cut. If they come down to 4.9, then that's 2. 4.6, that's going to be 3. 4.4, that's going to be 4 rate cuts. And then down to 4.2 or 4.1 really, that's going to be a full 5 rate cuts, right? 5 rate cuts, so that's about 100 basis points worth of rate cuts that the Federal Reserve is going to be pricing in. So there, you can already start to see how many possibilities there are because the markets may see from 5.1 going down to 4.6 as bullish, right? Because now the Federal Reserve is indicating more rate cuts, but that is still going to be less than what the market's pricing in. So you tell me whether that's going to be bullish or bearish, right? Because the Federal Reserve may be more optimistic or more easing, quantitative easing wise, they can be more towards the idea that, okay, we need more rate cuts and they can come down on these expectations. But if they don't come down enough, not as much as what the market's pricing in, is that going to be bullish? Is that going to be bearish? How is the market going to read into that, right? So I think that's really what the key is going to be tomorrow is this number right here. What ends up being the dot plot and what are the FOMC members expecting for interest rates to come down to? Because in our last Federal Reserve meeting, in the June meeting, when the SEP came out, you'll notice that we went from 4.6 to 5.1. So it was a huge upwards revision, meaning that the Federal Reserve was going to be projecting for 2 additional hikes. In other words, we're going to keep rates where they are at 5.3. And in other words, 2 fewer cuts. Let me just put it that way. They were expecting 2 fewer cuts in 2024. And, we had a whole discussion about that as well. And the markets essentially dropped back in June on this catalyst. So yeah, that's where the importance is going to be given to in terms of those numbers. And now coming over to some of the other data points, which I think are going to be important going into tomorrow. This right here is from Ryan Detrick. The Federal Reserve has cut interest rates with the stocks near all-time highs 20 times. And the S&P 500 is higher a year later 20 times. So that also is a little bit of a indication that rate cuts in general tend to be bullish. But we also discussed what the fast cutting cycle versus a low cutting cycle can do to the market, which is going to be over here. A fast cutting cycle, which is a 50 basis point rate cut, generally, not always, but tends to be a little bit less bullish than a slow cutting cycle. A slow cutting cycle, we got a 100% track record to be higher 21, 63, 126, and 252 trading days later, with an average of, very well 19 to 21, 22%, versus a fast cutting cycle, we've seen probabilities to be lower for us to be green, and also when we are red very, very sharply. And the gains are also not as high as in a slow cutting cycle. So those are some things to keep in mind, of course, going into tomorrow. Volatility usually peaks in election years in October. We have discussed that before. And this right here is going to be the potential trajectory for the market if we are accompanied with or without a recession. Really just 2 different paths the markets can take. And as I pointed out before, the Federal Reserve, most of the work for the Federal Reserve, the Treasury market has already done. So they've been kind of front-running the Federal Reserve. And a lot of people have been asking questions about whether the rate cut tomorrow is going to benefit TLT and TMF. Well, it's already priced in. I mean, to a lot of extent, the bond market's been already falling, right? You can see the federal funds rate pretty much flat, but the bond market's already been doing a lot of the work for the Fed. They've been front-running these rate cuts, and they've been dropping further, which has been pushing TLT and TMF higher, right? So it's already been baked into the bond market, but you just never know what kind of surprises we get tomorrow with the SEP, with the statement, with the speech. So there's most certainly going to be a lot of volatility going into tomorrow. Retail sales numbers came out, so 0.1% was the actual increase. Consensus was negative 0.3%, so we continue to see a very strong retail sales number. X-vehicles, 0.1% also, and X-vehicle and gas, we were up 0.2%. Money Vest Index now approaching close to 4 again. Volatility has dropped down to 17, although we were much lower during the day. 47 percentile. Over 70% of stocks trading back above their 50 or 200 simple moving average with a 59 RSI at the moment as well. So coming over to the market, congratulations on the all-time high, everybody. Very, very nice, a new all-time high from the S&P at 5670. I essentially captured that in on my phone, and of course sent out an update around that time. But this right here was the resistance. We gapped up, we pushed up to that resistance, then sold right back down, and we're back below that resistance of 5640. So it seems like the sellers or the bears did a pretty good job kind of pushing us back lower below that area of resistance, and that is going to be that level to keep in mind going into tomorrow, which, like I said, is going to be very, very important. And support level is going to stay put at 5565 down to as low as 5400 for S&P 500. So that's really where we are going into this meeting tomorrow. QQQs also getting rejected perfectly. I mean, it's actually quite crazy. And again, I haven't moved these charts. I want to be very clear. I do not play around with these charts, these red rectangles or the lines or anything. You can go back to yesterday's video as well and really see for yourself where that line was. And it's actually quite crazy because you take a look at this line. It's at 477.59 was the high for the day. And we've got this line sitting at 477.62. So we were off by just 2 points here. 0.02 cents is what we were off by. Crazy. So got rejected, sold right back down, and that is going to be the huge resistance that we're kind of battling right now on the NASDAQ 100. Support level is going to stay put at 468 down to 464 for QQQs moving forward. Volatility here starting to roll over very nicely, but just a little bit pushing higher, up over 2.7%, so 17.6. I also want to discuss the dollar index, which is weakening, or at least it was weakening. We're seeing a little bit of strength coming back in on the day, up over to 31 basis points, essentially trading down to a support. With this right here is a level that we've talked about before. It's been a very strong support for the dollar, and it's really been consolidating sideways in that range for a really, really long time, since pretty much 2022. So if there's any strength in the dollar moving forward, that of course is not going to be good news for equities and for S&P 500. So tomorrow's rate decision is most likely going to be affecting a lot of different markets, including the dollar index as well. Coming over to Apple, and Apple here dropping further. So we did see a little bit of a sell-off here. This right here is going to continue to act as a little bit of a support or a resistance depending on where we're trading. But 216, that's a level where Apple's been kind of battling back and forth. And if we continue to see a bit of a pullback or some more weakness, then I would not be surprised to see Apple in the low 200s again. So 2.4% sell-off here potential. $207 is going to be that next support level to watch for Apple. Going over to Amazon, and Amazon here once again getting rejected at that resistance at $189, $190. So this right here is going to be that level to keep in mind, all the way down to support at $181, down to as low as $173 per share. So a lot of consolidation sideways for Amazon in that range. Tesla, on the other hand, continues to move up slightly. It was up a lot more intraday, but still struggling at that resistance. So this right here, we're finally back up to that resistance here in the 230s, and this area of supply for Tesla once again. So there's going to be a lot of resistance that Tesla needs to break out of in order for us to see some new highs for Tesla in the 250s. So huge area of supply and resistance sitting right there for Tesla. My NVIDIA calls expire Friday, 111. If NVIDIA trades below 111 this week, it's going to be beautiful. But of course, I don't want it to be trading below $107 or $108 because those are my cost basis and my put strikes. But my adjusted cost basis is down in the 105 levels. But this right here, very, very strong resistance for NVIDIA. It's still continuing to get rejected here. 118 continues to be a very strong resistance that it's not able to break out of at the moment for NVIDIA. And support level is going to stay put, of course, down to $96 per share. And I definitely did poke a bear when I was talking about NVIDIA from a more objective fair value standpoint, because boy, oh boy, everybody's so bullish on NVIDIA right now. So don't talk anything bad about NVIDIA. I'm just going to shut up, trade my NVIDIA, and be happy with my profits. 142 is going to be that support for advanced micro devices. So that right there is going to be that level to watch. Resistance all the way up to 162. And coming over to stocks like PayPal. PayPal had a pretty decent day. I think a little bit of an outperformance here, up almost 1%. So support level inside this green rectangle. Resistance back up to 73.74. Getting a nice little bounce back higher from those levels. Visa, we've talked about it. New all-time high for Visa. Very, very nice. RSI, MACD, incredibly overbought. So be very careful with where Visa is right now. Certainly not a price point where I would go long. and this right here is going to be turned into a new support, although wouldn't be surprised for us to break down below that support back down to 282 for Visa moving forward. Talking a little bit about Meta platforms now, and Meta here on the day continues to trade back up to its resistance. This is a third time we're testing this area of supply, maybe third time's the charm. We'll find out very soon, but this right here is where we are once again at $540, and support level is going to stay put down to 479, 480, down to 458, down to 420 for Meta. Netflix, on the other hand, also starting to break out a little bit from this potential bull flag here, and support level is going to stay put at $700 now, so we're going to turn that level back into a support. I think it's a new all-time high for Netflix. Actually not, $711 is the all-time high, so would not be surprised to see Netflix kind of break out above that level fairly soon. Google, on the other hand, continues to see a little bit of that reversal, 81 basis points higher, so that's good to see. We've got a huge target and supply zone coming up to 164 for Google. It was incredibly oversold, so it's not a surprise why we're seeing a nice little rebound there, and support level is going to stay put down to 149, 150 for Google. And finally, we come over to Microsoft. Microsoft gapped up, sold off intraday, still a green day on the day, so support level is going to stay put down to 432. That right there is going to be that area of support for Microsoft. Didn't quite break down from this head and shoulders. Neckline was sitting down in the low 400s, but did a very good job in kind of bouncing right back up with the buyers stepping in, and support level now sitting roughly at 432. Enphase had another very strong day, pushing up a little bit over 6% here. Really just been trading, consolidating sideways in that range for a very long time. 124 is going to be that resistance. Support level down at $95, $96. And again, a lot of consolidation sideways for Enphase right now. So resistance all the way up to 124. If you do get a breakout above this level, back up to 138 is going to be that next level to keep in mind. And then finally coming over to Costco, starting to roll over. Not a surprise. Resistance was sitting at 918. Next support down as low as $872 per share. So there you have it. That's the entire update for today. Tomorrow we've got a big day. Make sure that you do participate on those polls. Join us during our live stream. We're trying to break some records here, and we'll see what happens tomorrow with the Federal Reserve, what kind of interest rate decision we get, and what the market's reaction is going to look like. So make sure that you drop a like, subscribe to the channel. Links to our Discord and Patreon is going to be down below if you want to join. Of course, be a part of our MoneyVest community. 16% off until the end of this month. As always, happy investing. I'll see you all in the next video.